Liquidity ratios are used to measure a business's ability to pay off its short-term obligations. This video identifies two liquidity ratios, the first being the current ratio and the second the liquid capital ratio, also known as the acid test ratio. We will look at where to find the information for these ratios on a statement of financial position, how to calculate these ratios, and finally what they tell us about the business. The first thing we're going to look at is why liquidity ratios are used. A business uses liquidity ratios to assess its ability to meet its short-term financial obligations. They are of particular interest to those who may be providing short-term credit to the firm, as the ratios will show how easily the business will be able to repay its debt. There are two ratios that are commonly used to analyse the liquidity of a business. The first is the current ratio, and the second the liquid capital ratio, also known as the acid test or quick ratio. The information used to calculate liquidity ratios can be found on a business's statement of financial position. Let's have a quick look at the key elements of a statement of financial position and what information is needed to calculate liquidity ratios. This is a statement of financial position for business Z. In order to calculate liquidity ratios, it's important that you know what to look for on a statement of financial position, also known as a balance sheet. The information needed for the statement of financial position are as follows: current assets, which is shown here, current liabilities, and your inventory. These are the three things needed to calculate both ratios. Pause the video if needed to familiarise yourself with the statement of financial position. We only need these three bits of information to calculate the current ratio and liquid capital ratio for business Z. The first liquidity ratio we're going to calculate using the information from the statement of financial position is the current ratio. The current ratio is calculated by dividing your current assets by your current liabilities and provides you with a ratio that shows a relationship between the two. Both can be found in the statement of financial position discussed in the previous slide. If current assets are greater than the current liabilities, then this means the business is in a healthy shape as it has the ability to pay back any short-term financial commitments. However, if the ratio is less than 1:1, then this indicates that the business has less current assets than it has current liabilities, and therefore may struggle to repay its short-term obligations. Using the information from the previous balance sheet, let's put some numbers to this formula. The business has current assets of £175,000 and current liabilities of £140,000. When you divide these following the current ratio formula, you get an answer of 1.25 to 1. Therefore, this shows that the business has 1.25 current assets for every one liability, meaning that the business has enough current assets to cover its short-term financial obligations, putting it in a relatively healthy position. The second ratio is the liquid capital, also known as the acid test ratio. This formula is very similar to the current ratio. However, the key difference is that the ratio excludes inventory from the business's current assets. This is useful to know, as inventory takes time to sell and possibly could not be used immediately to settle debts as easily as cash could. The liquid capital ratio is calculated in the following way: current assets minus inventory divided by current liabilities. This calculation is useful as it tells the business whether it can meet its short-term financial commitments without having to sell through its stock/inventory. In other words, just cash and debtors are measured as current assets. If you use the information from the previous balance sheet, then the calculation would look like this: current assets of £175,000 minus £120,000 inventory, this equals £55,000. Divide that by 140,000, which gives you 0.39 to 1. This example shows that business Z is illiquid, as it has less than half the amount of current assets excluding inventory to every liability, meaning it could struggle to pay its short-term financial obligations without the sale of its inventory. So, now we've calculated the current ratio and liquid capital ratio, let's interpret what these mean. The first thing you can do is use it to make comparisons to competitors within the industry, and also investigate liquidity trends from within the business year on year. The current ratio for business Z is 1.25 to 1, which shows that the business can meet any short-term financial obligations. Problems may occur if the ratio was below 1, as it would indicate that the business had liquidity problems, and therefore needs to put in place financial measures to resolve this. The current ratio can also be too high and could show that the business is sitting on too much cash that could be invested elsewhere in the business to achieve a greater rate of return. However, 1.25 is a little on the low side, but is still an acceptable figure. The liquid capital ratio is a good indicator of true liquidity, as it shows a more realistic view as stock can take time to turn into cash, and therefore may not be truly liquid. Like the current ratio, any business with a liquid capital ratio below 1 would indicate liquidity problems. This is where business Z fails miserably in terms of its liquidity, as the liquid capital ratio sits at 0.39 to 1, which shows the business has less than half the amount of current assets to current liabilities. Such a drop in the liquid capital ratio compared to the current ratio shows that the business is holding a large amount of its current assets in stock. Thanks for watching, and I hope you have a better understanding of liquidity ratios. And if you found this video useful, please hit the like button and don't forget to subscribe for more weekly business videos.